Revenue cycle is very important, especially in management accounting. I will now discuss the three processes that constitute the revenue cycle. First, receive order. The sales process begins with the receipt of a customer order. At this point, the customer order is not in a standard format and may or may not be in a physical document. Orders may arrive by mail, telephone, or by a field representative. When the customer is also a business entity, the order is often a copy of a customer's purchase order. Since the customer order is not in a standard format that the seller's order processing system needs, the first task is to transcribe it into a formal sales order. After creating the sales order, a copy of it is placed in a customer's open order file for future reference. Given that preparing an order may take days or even weeks, the open order file thus enables customer service employees to respond promptly and accurately to customers' questions. Then, credit check. Before processing the order further, the customer's creditworthiness needs to be established. The circumstances of the sale will determine the nature and degree of the credit check. For example, new customer may undergo a full financial investigation to establish a line of credit. The credit approval process is an authorization control and should be performed as a function separate from the sales activity. The receive order task sends the sale order to the check credit task for approval. The returned approved sales order then triggers the continuation of the sales process. Moving forward, pick goods. The receive order activity forwards the stock release document or picking ticket to the pick goods function in the warehouse. These documents identify the item of inventory that must be located and picked from the warehouse shelves. It also provides formal authorization for warehouse personnel to release the specified items. After picking, the goods and verified stock release documents are sent to for shipping department. If inventory levels are insufficient to fill the order, a warehouse employee adjusts the verified stock release to reflect the amount actually going to customers. The employee then prepares a back order record, which stays on file until the inventories arrive from the suppliers. Finally, the warehouse employee adjusts the stock records to reflect the reduction in inventory. Then, shipping the goods. Before the arrival of goods and verified stock release document, the shipping department received the packing slip and shipping notice from the receive order function. The packing slip will automatically travel with the goods to the customer to describe the content of the order. The shipping notice will later be forwarded to the billing function as evidence that the customer order was filled and shipped. Upon receiving the goods from the warehouse, the shipping clerk reconciles the physical items with the stock release, the packing slip, and the shipping notice to verify that the order is correct. The shipping clerk packages the goods, attaches the packing slip, and completes the shipping notice and prepares the bill of lading. The bill of lading is a formal contract between the seller and the shipping company to transport the goods for the customer. It establishes legal ownership and responsibility for the goods in transit. The shipping clerk then records the shipment in the shipping log, forward the shipping notice and the stock release to the bill customer function as a proof of shipment. Lastly, bill the customer. The shipment of goods marks the completion of the economic event and the point of which the customer should be billed. When the customer order is originally prepared, some details such as inventory availability, prices, and shipping charges may not be known with certainty. In the case of back orders, for example, suppliers do not typically bill customers for out-of-stock items. Billing for goods not shipped causes confusion, damages relations with customers, and requires additional work to make adjustments to the accounting records. To prevent such problems, the billing function awaits notification from shipping before it bills. Upon arrival, the items shipped are reconciled with previous sales order with unit prices, taxes, and freight charges. The completed sales invoice is now the customer's bill. A company has a certain percentage of sales return. These are some of the reasons. This is why we have to discuss about sales return procedure. When items are returned, the receiving department employee counts, inspect, and prepare a return slip describing the items. The goods, along with a copy of the return slip, go to the warehouse to be restocked. The employee then sends the second copy of the return slip to the sales function to prepare a credit memo. Upon receipt of the return slip, the sales employee prepares a credit memo. This document is the authorization for the customer to receive credit for the merchandise returned. The credit memo is sent directly to the billing function, where the customer's sales transaction is reversed. The credit manager evaluates the circumstances of the return and makes a judgment to grant or disapprove credit. The manager then returns the approved credit memo to the sales department. Upon receipt of the approved credit memo, the transaction is recorded in the sales. The credit memo is then forwarded to the inventory control function for posting. At the end of the period, total sales returned are summarized in a journal voucher and sent to the General Ledger Department. The inventory control functions adjust the inventory records and forward the credit memo to accounts receivable, where the customer's account is also adjusted. Similarly, accounts receivable submits an AR account summary to the General Ledger function, then reconciles the figures and posts the adjustments. Cash receipt procedure. Using open mail and remittance advice upon receiving payments from customer, the portion above the perforated line is usually the remittance advice, which the customer removes in return with the payment. This task greatly is simplified when the customer provides necessary account number and posting information. Errors are avoided and operational efficiency is greatly improved when using this method. A cash receipt employee verifies the accuracy and completeness of the check against the pre-list. Any checks possibly lost or misdirected between the mailroom and this function are thus identified. Next, the clerk prepares a bank deposit slip showing the amount of the day's receipt and forwards this along with the check to the bank. Upon deposit of the fund, the bank teller validates the deposit slip and returns it to the company for reconciliation. The remittance advices are used in the post of the customer's account in the AR subsidiary ledger. Periodically, the changes in the account balances are summarized and forwarded to the General Ledger function. Thus, upon receipt of the journal voucher and the account summary, the General Ledger function reconciles the figures, post to the cash and AR control accounts and files the journal voucher. Periodically, a clerk from the controller's office reconciles cash receipts by comparing the following documents. And that's end our revenue cycle.